Look at the number of restaurants that Swiggy has had live 6 quarters back and what they have today. So they had 183,000 restaurants, which has gone to 234. So they have been pretty slow in acquiring more supply on the restaurant side. And if you look at the number of restaurants that Zomato had, 226, they have continued, while they were at a higher base, they have continued to accelerate on that base as well.
So if you look at the adjusted EBITDA as a percentage of revenue, Blinkit is almost break-even, whereas Swiggy is minus 70%. And that tells you that Blinkit has a lot of lead in terms of the capital efficiency around this business.
The profitability pressure that Instamart has seems to be playing on their mind a little in terms of the pace of expansion.
The margin profiles are significantly different, right? Swiggy is at a negative 70% adjusted EBITDA, 70 to 78%, and Zomato is under negative 1%, right? So almost kind of break even.
This was one chart which came in ET, which is about how much some of the investors made in the Blackbuck IPO. Axel was the first investor, ended up doing 4.5x. We judged the restaurant by the price of the famous dish. Nobody asked for कि पानी की bottle कितनी की. So value added services में सबसे ज़्यादा margin है. Main में कोई नहीं बना.
Guys, welcome to episode 4 of Asymmetric. Today is an experimental one, by the way, because we realized that a lot of our views, a lot of you were kind of watching some part of the episode because Monday is a difficult day, so you would kind of watch it along the week. So we thought we will shoot maybe a few days in advance and release it on Friday. So hopefully you guys can watch it over the weekend, and we are probably doing it at night on a weekday. So apologies if there are some production issues at our end, but super exciting show ahead for you. We again have our OG member from the Asymmetric Crew, Darshit. Welcome back, sir, for some meaty topics today. Again, quick deep dive into a few of the public market earnings results, a couple of an IPO that happened a couple of weeks back, but a super exciting episode ahead for you. RB, over to you.
Thanks a lot, Shantanu. I think I'm not that kicked about shooting at night. But clearly with our day jobs, it's going to be harder to do this on weekdays. So actually, I am okay. My family is not very happy considering I'm going to get quite late today. But good to see you guys. Hopefully, all of you are watching us or hearing us over the weekend. While we are effectively summarizing a few of the exciting events that happened in this week in the startup ecosystem, as well as overall the broader entrepreneurship and builder ecosystem in India. So would love to start out with, I'm sure if all of you have watched the first episode, you know why Darshit is here. Swiggy announced its Q2 results, the first results that it announced after the IPO. Everyone was waiting for them, primarily because in the last 1 year, I think there have been a lot of exciting numbers and market shares thrown here and there. And as Harsha keeps saying that it's unfair to compare a publicly listed company whose numbers are validated and shared with the stock exchanges as well as the broader shareholders versus a privately run company where at least people believe that there could be different ways of reporting numbers and comparisons being thrown in. So it was super exciting to see now all the numbers of Swiggy as well as Zomato being publicly available in the stock exchanges. And we thought who better than to get Darshit and sort of get a deep dive into what does the Q2 result show us? Where do we think we are headed in terms of food delivery, quick commerce? What was noise? What was good PR? And what is the reality is something that we are excited to learn. Over to you, Darshit.
Oh, awesome. Thanks, guys. Should we fire up that Excel or?
Yeah.
Okay.
There you go.
Yeah, I think I'll just go with my key takeaways from the results. In my view, I think the most exciting thing about this quarter's result for both Zomato and Swiggy is that quick commerce continues to grow, right? If you look at, in fact, Swiggy's quick commerce continue to grow at much faster pace compared to last quarter. They have almost grown 76% year on year, which is amazing, right? So if I just project this out, I feel that quick commerce will be a larger business than food business for both of them probably a year out from now, right? And that is amazing, right? So that's the first big takeaway for me actually personally. In terms of the market share, it seems like it's a status quo that Zomato is what 1.8x of Swiggy, and that continues to be the case in quick commerce. And similarly in the food also, the market share continues to be on a status quo. I think what is interesting to me is the adjusted EBITDA of quick commerce business for both Instamart and Blinkit, which is vastly different, right? So if you look at the adjusted EBITDA as a percentage of revenue, Blinkit is almost break even, whereas Swiggy is minus 70%, and that tells you that Blinkit has a lot of lead in terms of the capital efficiency around this business. So those are at least some of my key takeaways, but we'd love to hear how you guys think about the results.
Darshit, for our viewers, can you just quickly tell them what adjusted EBITDA means? Like what is being adjusted here?
Yeah, so typically speaking, in a EBITDA, you will have a non-cash component in form of ESOP cost. So once you remove the non-cash component, then adjusted EBITDA is after adjusting for all the non-cash components. Yeah.
Got it.
I agree with you, Darshit. There are excellent results. Very exciting to see both, quarter numbers now publicly available. I actually did a little bit of deep dive to understand what is it that's driving this difference in EBITDA. I think it's a fair point that if Blinkit is almost break even on adjusted EBITDA and Instamart, and I think they gave guidance as to when Instamart would break even on adjusted EBITDA, as well as when the overall business, Instamart plus Swiggy, would break even. And I think, obviously, the group business would break even a little sooner because they expect the positive earnings or positive cash flows, positive EBITDA of the food business to sort of help get the group EBITDA positive sooner. I think 2 quarters sooner or 2 or 3 quarters sooner than just the Instamart business. But I actually went a little deeper into understanding what's happening on the ground. And while the growth rates year on year on a percentage basis seem to be favoring Instamart today. So I was looking at this, right? So excuse the big Excel sheet. We'll share the link later. But broadly, I was looking at the last 6 quarters. Then this is all publicly available data on both Swiggy and Zomato's shareholder data that they give on their website itself. And I was looking at broadly 2 aspects, like what's happening in the food delivery side and what's happening, because we are looking at the output, which is the lagging indicator. The numbers and the EBITDA are the lagging indicators. What is the input? So for the food delivery, the input is number of restaurants that you have live. What is the orders that you can do per restaurant? What is the take rate that you can have per order, right? What is the AOV per order? These are the broad 3 or 4 metrics that will drive the revenue, market share, and EBITDA for the food business. Similarly, for quick commerce, it's the number of dark stores. What is the revenue per dark store? What is the contribution per dark store, which will also again depend on the take rates. So you have
a really good metric with Darshit have, which is orders per dark store per day. I think that's a very clear indicator. I'm sure the leadership at both places is kind of looking at that very keenly. Sorry, Revant.
Yeah. So if I look at the food delivery business, the GOV. So there was always a decent gap between Swiggy and Zomato for the last 6 quarters. But what's interesting to see is look at the number of restaurants that Swiggy has had live 6 quarters back and what they have today. So they had 183,000 restaurants, which has gone to 234. So they have been pretty slow in acquiring more supply on the restaurant side. And if you look at the number of restaurants that Zomato had, 226, they have continued, while they were at a higher base, they have continued to accelerate on that base as well. And it's not that their GOV per restaurant has changed that much. So Swiggy sort of remained same. In fact, while they have increased the number of restaurants, their GOV per restaurant has gone down, albeit a little bit. It's gone from 3.3 lakhs to 3.1, whereas Zomato has maintained it at about 3.3 lakhs. So if you understand this, what's happening is Zomato is able to give 3.5 lakh rupees of revenue to each one of its restaurant partners. Swiggy is able to give 3 lakhs, 3.1 lakhs to its restaurant partners, and Zomato is doing it at a 50,000 more restaurants than Swiggy, and it continues to add more. So just last quarter, Swiggy only added 10,000 restaurants in supply. Zomato added about 16. 16,000, right? So you are adding more restaurants every quarter and you are giving more revenue per restaurant as well. So it's a very interesting metric to see how this plays out. But and while we are looking at the market share, I think the core thing for any marketplace business is how much supply can you have. If you go back to the second episode or the first episode where Chirag mentioned that e-commerce broadly is a function of price, selection, and convenience, right? So while both are giving convenience of 30-minute food delivery or 45-minute food delivery, and prices, I don't know if restaurants price it differently on Swiggy versus Zomato, but the selection continues to be a interesting aspect that Zomato seems to be focusing on. Either they are going deeper within the same areas or they are expanding into newer cities that Swiggy is not operating in. But one of those two things has to be the case. And the second important thing is if you see the gap between the take rate for Swiggy versus Zomato, Swiggy actually is a higher take rate than Zomato, right? And I kept wondering that at a higher base of restaurants and giving more revenue to a restaurant partner, why would Zomato want to operate at a lower take rate? And I think this is an interesting management decision that we should look at even on the quick commerce side, right? So if we come down and I'll show you the quick commerce difference as well. Look at the number of dark stores that Swiggy had Q1 FY24. It had 421 and it has been slowly adding every quarter. And that addition has got accelerated in the last 2 quarters, right? They have sort of started accelerating the number of dark stores. In fact, they put the highest number of dark stores in the last 6 quarters in the last quarter itself. Q2 saw a significant expansion.
Yeah.
But look at the pace of expansion of Blinkit at the same time, right? They've gone from 383. So they were behind Instamart till Q4 FY24. So as of end of March 24, they were behind or just about the same as Instamart. But they have pulled away much more significantly in the last 2 quarters, including Q2 as well. And while they are doing this, it's not that the AOV, the gross order value has dropped per store, right? Neither has the orders per store dropped. If you look at the orders per store, broadly, Blinkit remains ahead of Instamart, though Instamart has worked significantly in the last quarter and increased it from 1 lakh orders to 1.08 lakh orders, right? So clearly, both are on an aggressive expansion spree. Another metric to look at is the number of users. So the number of users on Instamart is a little lower than Blinkit, which I'm assuming translates to the demand that these dark stores are seeing and the number of dark stores these guys are putting. But if you see the orders per user is almost the same.
Almost the same.
Very interesting to see. Right?
Very interesting.
So if you ask me, my conclusion from this, and of course I may be completely wrong, but seems like the profitability pressure that Instamart has seems to be playing on their mind a little in terms of the pace of expansion. Because if you start putting 100 dark stores a quarter, suddenly the loss will balloon because there will be capex. And initially for the first 1-2 months, the store may not be profitable, right? Because you may not have demand on day one itself. So I don't know how this works, but seems like there's a more cautious approach from Instamart on the food side for Swiggy as well as on the quick commerce side for Instamart. And Blinkit plus Zomato seem to be leveraging their adjusted EBITDA break-even on quick commerce plus a significantly positive adjusted EBITDA on the food side to continue to expand their supply and try to get more restaurant partners on board as well as try to increase the number of dark stores. That's the broad takeaway, at least I saw from the publicly available data. Would love to get your thoughts as well.
Yeah, one thing for me was like I completely agree. I think they're both on breakneck speed, but I think the margin profiles are significantly different, right? Swiggy is at a negative 70% adjusted EBITDA, 70 to 78%, and Zomato is under negative 1%, right? So almost kind of break even. My question, Revant, to you is, and Darshit to you is, it sounds logical that when you are expanding at breakneck speed, it will kind of affect EBITDA because you are investing and it's front loaded. But somehow Blinkit has managed to do it without that. So it's gone to 690 stores from lesser stores at a dark store, and they have not seen a drop. One is, I think the execution, whether it's an assortment or pricing or customer acquisition, execution is maybe top notch, but still the they've not seen a drop in orders per store per day. They have not seen a drop in retention, and actually that load has not come on the EBITDA at all, despite the addition. So I'm wondering whether this is just an execution efficiency thing or there is something else. There's a trick that they're able to get there.
Yeah, but look at this, na Shantanu, and it's doing the CM percentage also, right? Let's take because I looked at absolute. I think it's an unfair because the bases are different.
Correct.
So if you see the starting point itself, Blinkit was at -4 and they have increased it to 20% CM.
Correct.
And Swiggy was at -62. They have done a phenomenal job to get to -13. So both of them are improving efficiency for sure. I think it was just that the starting point seemed to be much more off.
And is that, Revant, one of the factors which you were showing, is that because of the high average order value which Zomato has?
Could be the case because the take rate.
How much of that is explained by the average order value? It was significantly different.
Yes.
Significantly different. The take rates were higher for Blinkit.
Correct.
And on that higher percentage, their AOV is significantly higher because their AOV is 660 against 510. But it's good to see that Instamart's also increased that, but it's not increasing at the pace at which.
Yeah, it's still maintained. So the difference continues to be largely 30%. Right?
Yeah. I think. But look at the users per store also, right? Even at the higher store base, there are 200 more dark stores, but the number of users that they have per store is similar. The number of orders per store they have is similar. So it's just a function of what is the order size and the take rate. So the absolute contribution margin per order is a function of that, right? That per order, what are your, the cost may be similar. They may be paying their delivery guys or it is similar, plus minus 5 rupees, 3 rupees. But clearly at a higher average order value and a higher percentage take rate, the revenue per order just seems to be much higher for Blinkit. That is leading to this. And if they can keep that lead, their ability to put up 500 more dark stores at this positive economics is much, and they'll burn much less capital. And it's uncanny how they are able to do this even at this scale. In this, because we mentioned it in the first episode, I actually think there's been a slight change. There was a lot of data news around Swiggy losing market share in food delivery. Not only have they actually proven that it's not degrowing. In fact, last quarter is very slight, but there's a 0.1% higher. If I just look at Swiggy GOV and Zomato GOV, Q1 to FY25 to Q2 FY25, Swiggy's actually gained 0.1% in food delivery, which is against all the rhetoric that we have heard in the last 2 years that, oh my God, what's happening? In fact, in episode 1, I think, Chirag, you had asked that what happens, can Swiggy afford to lose more market share? Clearly, they have said no, and they have executed in a way that they have actually gained market share in spite of, and I'm talking about absolute overall GOV. So in spite of having lesser number of restaurants which is amazing, right? You have lesser number of restaurants, you have lesser number of transacting users, but you have actually managed to get more market share. So it's a clear, and you have a higher take rate as well. And I kept thinking that how did they do that? And I spoke to a few people. There seems to be an interesting trend. Zomato had tried 10-minute delivery and then said that this won't work. This was about a year and a half back. Swiggy Bolt, which is a 10-minute delivery, a few restaurant partners I have spoken to off the record have said that wherever they have their restaurant live, and they have Bolt also live, which is 10-minute delivery, and they have their full menu, which is a limited menu, and their full menu. The number of orders on Bolt is almost 15 to 20% already of all the orders that they get in that particular catchment. So it seems real that the 10-minute excitement that took over retail and grocery may actually even translate to food. People will swing.
What they are doing differently is like Flipkart minutes, wherein you scroll the entire catalog and whatever is available in 15 minutes showed as Flipkart minutes. It's not a separate one.
I don't think that
Similarly, I've seen on Swiggy, there is a Bolt section. And now on this also, I saw, for example, on one of the dishes that this is qualified. I think so. Folks, should we move on to our next company in discussion?
Yes, absolutely.
Okay, we have one another interesting company to discuss today, Blackbuck, which IPO'd recently. Most people think of it as a logistics business. It's not. It's a SaaS business. It's around freight logistics. So they're trying to digitize the entire freight logistics. It's very interesting from that point of view that it's a SaaS company, got listed in India. I'll just pull up few charts in terms of how the
Go ahead. Before you go ahead, like for a lay person who does not understand these words fully, can you explain the business quickly in a minute or two, and then we can go into the
I was coming to that. So, think of trucking as an industry, which is used for freight transportation. You have various different use cases which need to be solved for. Broad one is, you want to book something and then you want to reach out to a truck operator who will lease you or give you the fleet and then you will take your shipment, it'll get delivered. Well, there are, if you go deeper, there are many such things as paying tolls and then fuel recharges, various insurance services which come with truck. That's there. And now when you think about digitization, there is this GPS installation which comes in. So it's their view is that can you digitize the entire freight logistics and make a business out of it? I think the large goal is to build out a freight logistics marketplace of sorts. And I think they've got few things right. My sense is that they entered this business via doing the fulfillment business fully, and which they've shelled off recently. And what has worked beautifully for them is that they've got on to this digital public infrastructure called FASTag. And they are now the one, they collect 1/3 of the FASTag collections through Blackbuck now. So it's an amazing stat. I'll just show you a few things in terms of, how fantastic is this.
1/3 of the trucks collection.
Yeah. So 33%. So total FASTag collection is 54,000 crores. They collect close to 18-20,000 crores.
Of all FASTag in the country or only truck ka FASTag?
All I think is 54,000 crores.
पूरे country में गाड़ी plus truck.
Yeah.
Wow.
So they got listed and, I think it's been only 7 days. The stock is up 35%. I just quickly move on to the beautiful part of this that, the interesting part is there are now the government has mandated that all tolls have to be paid by a FASTag. Right? It's mandated, otherwise you pay up twice. Right? Which these guys have, I think in my view, it's a very good monetizable GTM for them, wherein they've entered through this, they have a significant share, they've acquired and, the underlying industry of freight is very, very unique that globally, it's a very fragmented industry, right? If you look at this chart, it's a very fragmented industry with very low tech adoption. I think in India also, this tech adoption has happened because government has mandated it. Average, there are 2 trucks per owner. So you can imagine that on the supply side, it's very, very fragmented and I think similar on the demand side. What it meant was that whosoever can get this supply can potentially have a shot at, let's say, building out a digital freight marketplace. I think what they've got right is getting this thing in place. I think interestingly, this was one chart which came in ET, which is about how much, some of the investors made in the Blackbuck IPO. Axel was the first investor, ended up doing 4.5x. And I think we have an interesting one to show on that one. I'll just quickly go back to that screen. So this was an interesting tweet which came up that Blackbuck got listed. Axel had invested way back in 2015. They have at the moment, and they've subsequently invested in those rounds at different price points. What it meant was that, TVPI in all subsequent rounds went down. And the point which at least this tweet was making was, which is at least I found that interesting, is that it's a defensive follow-on investment to protect their position.
So TVPI basically a term which is used to say total value to paid-in capital, right? So let's assume that you invested 100 rupees in first round and then you invested 15 next round, then you invested 13 the round after. So you invested 180 in total. And let's say today your total value is 400 rupees. Then let's say 400 divided by 180 is your TVPI basically. So whatever is the total capital you are paid in for a given investment, versus whatever is the value that is accrued on that investment. Basically, it's a ratio of that. It's a simple ratio which tells you at a blended level how much is the return you have generated on, and then this is showing it for each of the investment, right? So let's say the first investment Series A, the TVPI is 19.050. It means for the first Series A investment, whatever is the capital that went into the company, on that they have generated 19.5x return basically. And then post that subsequently for the second investment 4.05 and 2.6. And basically the most important point is for the last one, they are at 0.91 basically, which is nothing but that you are below your cost in terms of whatever investment you have made. Yeah.
So overall, from an investment point of view, the company at Axel has made 4.47, right? From an overall TVPI point of view. I think the question which came up is that, how should one think when they are following on in terms of investment? That, while you have entered and the company has done well, and now you know that, okay, it might be hitting a ceiling, there might not be growth, but then you always have a VC as a question that, company needs money and you got to back them. How does one, think about it in such a scenario?
Yeah. So I think this is a very hotly, to be honest, there is no right answer to it. This is very hotly debated topic, right? And this is one isolated example where the follow-on capital did not generate as good of investment as one would have liked. But there are more than enough examples where, let's say, your first round of valuation at which you entered was 10 million. The second round was 40 million. The third round was 100 million. The company went on to become a $15 billion company. It really doesn't matter whether you entered at 10 million, 50 million or 100 million, right? So I think while this is an example which shows that the follow-on did not generate enough investment, enough returns, but there are more than enough examples which can show you that it was the follow-ons were the brilliant investments, right? Basically. And so I think the way I would say this is how the way VC math works, right? I think for everybody's and Revant, you would already know that there is a power law, right? So let's say you build a portfolio of 30 companies. You know that 2 companies will return most of your fund basically, right? So let's assume you invested in 30 companies, 2 companies will end up generating most of the fund returns. Let's say if you're a 4x fund, 3.5x will come from 2 companies, just 2 companies, right? And there was an interesting article which I will share post this, that if you take top 10 highest returns of the funds, let's say individual fund which return the highest, let's say 20x, 25x, for all those funds, it was just that one investment which returned most of the fund basically, right? So if you take that one investment out of that, then everything else doesn't matter basically, right? So that's really how the math has worked out for most VC funds. Now, why this happens is when you are making an investment, you are always looking for a signal to say, is this company doing good, right? And if there are enough signals, you want to double down because you don't want to miss out on the winner, right? Because you don't want a situation that you identified the winner, you entered in the winner, and then you didn't double down and ended up with very poor ownership in that winner, basically, right? Now, of course, when the winner is there, when the verdict is out, then you lost the opportunity to double down, right? So as a VC, your job is to say, every time there is a round happening, for you to pick up the signal and say, is this a company I want to double down on or not, basically, right? And what happens in that process is that you will be wrong many times. Like, because let's assume company move from C to A. There are some signals which tells you company is doing good. So you double down, but it may happen that company at Series C really did not work out, right? So that will be many cases. But along the way, you will have 6, 7 such companies where you made follow-on investments because those companies kept raising rounds and kept showing the signals of growth. But of that 7, probably 3 will be finally they come out as winners and the other 3 may not come out as expected, right? For example, I know at some point Blackbuck was a fairly hot company, and I think it was an expectation that they may end up, because it's a freight logistics business, right? In India, freight logistics is a very large market. Expectation would have been, nobody expected them to become a SaaS company, right? And the expectation would have been they'll become probably a $5-10 billion outcome. And with that expectation, one would have made the investments, right? So I think the argument that follow-on investments don't generate as much return, this is actually taken in isolation. But if I look at the fund level, actually, and Revant and I are aware of one such investment from our past firm where we know that follow-on investment actually generated huge returns for the fund, right? So I think it's just the way VC math works, and there'll be many such examples, but there'll be many counter examples to tell you that if the fund wouldn't have made those follow-on investments, they wouldn't have generated the kind of returns that the fund ideally should have generated.
I think Zomato is a fantastic example. That InfoEdge and Zomato would have been a great example of just outsized returns for like multiple follow-ons in the initial days.
Exactly.
I also have on this, Chirag, I disagree with this tweet, and I'll tell you why. One, it doesn't take into the fact that the way venture works, or actually the way venture for sure, private equity would be different, public market would be different. The way venture works is when your seed investor, which is in this case was Axel, if they didn't do the pro rata and put that 69.32, I'm assuming this is crores. No, that's the cost of acquisition. Sorry.
Cost of acquisition.
The price went 4x, right? Broadly, the price, the share price went 4x. If they didn't participate and put some money at that point of time, the incoming investor would start questioning that, yeah, I am still coming in today, right? There is asymmetry of information. Public markets work very differently. Private markets work very differently. So if an incoming investor is seeing that the current investor who has access to a lot more data, who has worked with the founder and the management team for the last 18-24 months, who has every small intricate detail, or at least more detail than I have today, is not investing. Do they know something I don't? Is there something wrong with the company? So it's very difficult to do follow-on rounds in private capital or venture investing if your existing investors are not doing pro rata. In fact, it's almost like, and I don't think it's a defensive mechanism. Like what Darshit mentioned is that your returns will also come because you will continue to maintain your shareholding. But it's also important, if you believe in the company, to show the world that you believe in the company. Otherwise, the company won't be able to raise external capital, right? That's one. Second, I think look at the time periods. VC is not...
I'll just interject here.
Yeah.
So one is that, okay, your company is doing good, like in stock markets, if there is an upward trajectory, you continue to buy or even on the up curve, right?
Yeah.
So that's one strategy which is fair for, let's say, any company which you have identified that is a winner, right?
Yeah.
Now you are saying that, okay, if I've identified winner, I'll definitely back. Now I will continue to give signal to the market for the remaining of the portfolio also that I am, this is one of the companies which we are bullish about, continue to back them, continue to do pro rata. And that's what we continue to see here. So that company at least, is able to generate this 5x TPI, 4.5x TVPI. Rather than, just dying out because private market, as you're saying, it becomes hard if existing investors, first investors don't continue to be with the company.
And also on this, right, I think if you just look at August 15 and like one has to take our minds back to what the world looked like from August 15 to October 18. This was the heyday of e-commerce, right? This was like the shovel industry for the e-commerce growth. So we had Rivigo, Blackbuck, Ecom Express, all of these guys were going after the 150 billion, truck aggregation business. If you just look at their investments from August 15 to October 18, that 4.47 probably would be like a 5.5 to 6 in a 3-year period. So the IRR math for 5.5x in 3 years versus 4.47x in 9 years is very different. And that's where I think the difference comes, because that's where then you have to kind of stay put and that's the thing about a fund like Axel, which is they'll be like, boss, this is patient capital, long-term capital, will stay with the founder. They have a track record of being that way. And I think that is what gets the best founders for them even in the future. So I think at the end of the day, there's a judgment call at the partnership level. I'm assuming, Darshit, do you think that they would have, at some point, the discussion would have happened, ki, boss, we've got 6x in 3 years. We should cash out. I'm assuming there would be a secondary available, and or at least cash out half the amount and leave the rest for later. Like just or do you say there's a winner and we're going to glory?
I was coming to that only, that, if it was a winner, then why would you cash out? you will continue to double down
That's
and
not
at least,
true,
or
bro.
at least, stay invested. But I think that's a topic which we should cover sometime, that at what point, I've seen different VCs exit. At what point should you be thinking? But I think this is a very interesting business from multiple angles. One is, we have discussed this multiple times in different forums, that this is at least the strategy which has worked for them is the FASTag acquisition strategy, which is that they're in the payments flow business, right? And it has been proven many times, in different parts of not only India but globally, that if you're in the payments flow business, you figure out a way to make money. You have seen Bharat Pay do that, where they have installed QRs, and I remember everyone used to say, okay, what will happen to this business? And now we know, just because if you are in the payments flow business, financial services opens up, you are, seeing a lot more real things happening in terms of transactions. Would love to know, Darshit, from you, that how do you think about payments flow business and what are the advantages? One thing for sure I know is that it's a very dynamic business, right? You require dynamism in the team if you are executing that kind of a business. It's not a block business, right? It's very dynamic. It requires a different, skill set to execute a dynamic business. But outside of that, from a VC lens, how do you look at payment? They keep saying that get into the flow of money and we'll figure out how to make money. How do you look at that piece?
To be honest, in a financial services business for a long period of time, a lot of businesses look like how would they make money, right? And if you just look back, a lot of business, this question was asked when the businesses were actually very early stage, be it Bharat Pay or be it even Grow, for example, right? And many
Always, all real money gaming companies. I go back to 2017, 18, there was this boom of real money gaming companies and everyone's figuring out how do you make money out of this, 5, 10 rupees payments which are happening. Those micro payments. And now all of these companies are legit. They pay GST and they are like big profit pools.
Boss, क्या beautiful PNL लगता है वो. Just stacks up so beautifully.
So I think, in my view, I think, and this was the mistake even I made at an early stage of my VC career to say, yeah, how would these businesses make money? I think now the answer, at least I've come to, is that financial service is this unique business where relationship with the customer matters a lot, right? So basically, once you have the relationship with the customer and they have the trust on you, you are a trusted brand, you can layer in multiple products on the top of whatever of that relationship, right? Just think about bank. What is bank? Bank is, they have the relationship with you because you have your money lying with them, and then they'll tell you, okay, why don't you take a credit card from me and then take a loan from me and then sell you an insurance also, right? That's how the banks used to operate. In the digital world, I think that's what the payment companies have figured out. It's okay even if I don't make enough money through the payment flow, but I have a relationship with you as a customer. I have a lot of data on you. Then I layer in multiple products on the top of that, right? So be it Phone Pay, be it Paytm, be it Bharat Pay, all of them actually ultimately said, once I have a relationship with and I have a customer's lot of transaction flowing through me, and then I'll basically layer in multiple products on the top of that, right? And they are able to make the model work. And I think that is how I think about is that if you have a base layer as a product, which allows you to establish that trust and relationship, and payment is a beautiful product because on a consumer end, you are opening the app 3 times a day, almost 100 times a month, you are opening the app. It's like as engaging as it gets in terms of the application, in terms of the relationship. So I think payment.
But is there a, Darshit, is there a easiness when it comes to payments? So for example, in FASTag also, what they interestingly figured out that, if you have lower balance, you will be charged twice on the toll. What Blackbuck has figured out is that you can now take FASTag Gold, which allows you a credit limit and you will not be charged twice. And the beautiful part about this FASTag is that government has mandated that this is one per car for a lifetime. Right. So you will not, most likely, the default rates are going to be like close to zero. So does it, I'm just curious that does it make payments, a easier way to establish that trusted customer relationship and then figure out a business model I've seen this play out across payment modes, across countries. In Latin America, there's a payments company. In Latin America, by the way, payments happen T plus 28 days. Right now, everyone knows that for early day settlement, you can charge a premium. But I'm sure that at least my sense is that a lot of innovativeness is much easier if you are in the payments flow.
Yeah, yeah. I think I think if you look at that pattern exists, let's say even in Paytm, it existed in form of prepaid, right? Paytm prepaid or postpaid. sorry.
Postpaid. Yeah.
Yeah. So basically, you are making payments through your Paytm app, and now they said, you know what? Even if you don't have money on an account, I'm giving you a postpaid account where you pay money through that, and you pay the bill towards the end, right? That was nothing but a form of a personal loan. And now, once you have taken that 20,000 rupee postpaid, and then now when you need a 2 lakh rupee loan, your Paytm tells you that, you have a pre-approved loan from me, which comes at a slightly higher interest rate. You would probably prefer that over going to the bank and going through that whole hassle of getting the loan approved, right? And then now suddenly, now you have so much relationship with Paytm, you don't mind even buying insurance. So I think you're right. In a way, it's about the ease with which you are able to cross-sell the products is what matters. And that's really the matter of the product thinking of the team, how they are able to do that with the ease with which you are able to do that, right? So I was in fact discussing this with somebody that Cred, if you think about it, their customer base is probably more than 700 CIBIL score. And ideally, all those people can get loans from bank, but why are they getting from Cred? And I think the answer was that the ease with which people are able to get the loan, even if it's at a 2% higher interest, is probably they don't mind, right? So I think probably that's the answer in my head.
That should settle the debate that they have a trusted relationship with credit.
But do you think this goes to consumer tech also? Because Chirag, if you see how many cards were sold by Amazon, the Amazon ICICI cards. In fact, Darshit, you'll have the data on that. Or if I look at the HDFC Swiggy cashback card, it's very interesting to see that all the e-commerce companies technically are also in the payments flow, and advertising / lending / cards, like fintech coming into like EMIs, lending. I saw Blinkit has started EMIs now at 2,999. There's a pay in 3 option. So I think making money through fintech applications, even for consumer tech companies, and we know of even a brand, though it's on their own platform. So Country Delight, which is a milk to then dairy and now a grocery company subscription business, works primarily through a wallet, and like you pre-fill your wallet and then you pay, and obviously they can do lending also on top if need be, right? Not that we have done it, but I'm just saying, do you see this becoming mainstream for consumer tech companies as well?
At least what I have understood is a lot of consumer tech businesses look at this as a way to lock in the customers, right? So let's take an example of Amazon card, right? So the moment you have an ICICI Amazon card, and Amazon card gives you 5% cashback. If you had a choice of buying from Flipkart and Amazon, you will probably prefer Amazon because you're getting that 5% cashback through that card, basically. So at least what I've understood, the initial intent is not to make the money out of it, but to really create the loyalty, right? To say, even all the wallets, if I have the money in the wallet lying in that particular company's wallet, right, I would rather go and buy from there because it's an easy checkout, plus it's a lock-in, right? So at least the way a lot of these cards, even Swiggy card, is really that because I have a Swiggy card, I'm getting 5% cashback. I'm actually buying that, right? I think the way banks look at the relationship is very simple. That bank is saying, I am okay to lose money. Let's say if there is an ICICI and Amazon card, bank is saying, I am okay to lose money on, because bank only makes 2% and they are giving 5% cashback, basically, right? Bank is, I'm okay to lose money on the Amazon transaction, but I know that once this card is useful to the customer, they'll do a lot of non-Amazon transactions through the card, and that's why I'll make my 2%. So it's a great way.
How much do you make on non-Amazon transactions on the Amazon ICICI?
2%. In India, The MDR is 2%, right? So the banks are all making.
What is the cashback I get? Do I get any cashback for on that
I
card?
think it was somewhere around 1% or something like that. Probably 0.5% or 1%, basically.
So then there's no incentive for me to use the card beyond Amazon, no?
I think the behavior every bank will tell you is that every customer has 2 or 3 card on the top of their wallet, and if you become the top card on their wallet, they'll use that card everywhere. It's not.
So I think the Swiggy one, 10% cashback on Swiggy, 5% on all online spends up to 1,500, and 1% cashback on other spends up to 500. So there is a up to, which is a limit. Fair point. I think what you're saying is that banks want a longer LTV relationship with the consumer. But do you think how would a bank make money from these people? Because I don't think these are revolvers, or are these revolvers?
I think there will be revolvers, but more than that, most banks also end up making money on the EMIs, right? So when let's say I use the same card and I go to a Chroma and say I want to buy a washing machine using this card and convert them to an EMI, that's where they make a lot of their money, right? So if you look at any bank's PNL, the MDR is largely to cover the cashbacks and the incentives. Where they make money is really two things, revolvers and the EMIs, right? So I don't have a data around the revolvers, but I know for sure that EMI is where banks end up making a lot of money. Yeah. But I think the interesting statistics I heard last is that Amazon card was so impactful for ICICI that now it's significant, like 30-35% of the ICICI's total overall credit cards portfolio, right? Basically,
That's crazy.
Yeah.
That is crazy. And Amazon cannot be 35%. So it clearly shows that the Amazon ICICI card is being used on other places also, like tremendously.
Correct.
No, he's talking about, are you talking about the spend or the actual number of cards?
Number of cards.
So if ICICI Bank has 100 outstanding credit cards, 33 of them or 30 of them were acquired through the Amazon flow because of it. Wow.
Yeah.
And they don't clearly lose money on that. Otherwise, they would not have continued, right?
So that I don't have the data, but
Maybe we should evaluate the ICICI Bank results next time.
But what percentage of this becomes loyalty, which is unused, like loyalty, gift reward, etc. stuff that is unused? Where does that sit? Because I'm assuming that's also a big part of this. It's a big part of the stickiness.
Yeah.
So, and also increase in my view is that the bet is here. This will increase consumption for this customer.
Correct.
And then increase consumption because there's loyalty. Then it sits there. Sorry, Apple, American Express. Big part of it is like this unused loyalty points.
Yeah.
That's it.
Although I would have Yeah, that's true. Although I think when it's a cashback, generally unused is a highly unlikely thing. When it used to be those
Cashback, I agree. Not on cashback, but just loyalty points that are unused. That sits as a liability, then it lapses over a period of time. So lapse liability, like kind of feeds back beautifully also.
for points, yeah. I think India is one unique market to build out the ecom logistics as a business. There is no such thing in US if you think about this, basically, right? And there is a reason to it, right? So if you look at China is also unique and US is also unique and India is very different compared to both these countries, right? So China may most of the e-commerce is still largely by 2-3 large platforms, basically, right? The moment you have such a concentration of online business, right? It's very hard to build an enabler business, basically, right? Because then you are as a B2B business, the last thing you want is a customer concentration. And 3 customers gives you 95% of the business, then you can't run a business like that, basically, right? So in China, that way, while there are businesses which are doing e-commerce logistics, but not at the highly valuable, like the largest e-commerce logistics business I checked out there is like 15 billion in market cap, which is very low for a market like China because it's concentrated. It's Alibaba, Taobao, and PDD, and some of those businesses which are largely. In US, on the other hand, the logistics already existed in form of UPS and basically DHL, and some of those courier companies were well enough to do the logistics, e-commerce logistics, right? I think India had a unique situation where 2 things happened. When the e-commerce started, I remember the AOVs were like $1,200 or something like that, right? So you need a logistics which cannot cost you more than like $70, right? Which was which is not the case in US and China basically, because the AOVs are 3-4 times higher basically, right? And
They could use the existing infra. They didn't need to create the infra.
Create a new infra.
Right. So like UPS is a big, UPS, DHL are the big logistics provider in US, right? Just think on it, right? Basically. And second is they had wide enough network to be able to do that at the cost which e-commerce logistics needed it to be, right? Now India had this unique situation where the AOVs are low, so you cannot have the logistics cost $200. The economics won't work out. And hence, you needed the specialized 3PL players who can build out the logistics network. Now, if you think about India, initially also while Amazon, Flipkart were the large players, but already had players which needed the 3PL logistics, right? You had this bunch of fashion players and those players which needed the 3PL logistics, which was a very unique situation in India, and hence there was a need of thick stack. Thin stack was not even possible when this thick stack happened in the country, right? The Shipkart got built when India had then multiple of this thick stack, and then you wanted a layer on top of it for routing and bunch of other things, right? So the way I think about this is it's really the need of the market that one has to go by. If I take that definition, although not exactly, but if you think about this marketplace versus a kind of full stack e-commerce, India is actually a kind of, in a way, is a full stack e-commerce. Like marketplace is not a truly a marketplace business, right? Most of the GMV of these guys come through their own seller, basically. It's because the India didn't have the mature base of sellers who can sell on the, now it's maturing over a period of time. But I feel the logistics specifically, it was really the need of the market, because of which there was a choice to say that let's go out and build a 3PL logistics place. At least that's how I think about this right now. Yeah.
Yeah, that time I think the Blue Dart, DTDC, these guys were like really struggling.
Yeah.
Amazon, Flipkart, this was completely changed the fortunes. Of, like the Blue Dart India Post also, I forget the numbers now. I think if we can find them from 2011 to 2016, India Post also kind of saw a significant upswing on this front. So you're right, you're absolutely right.
Interesting. Just for viewers, delivery is today 25,000 crores market cap, and Blackbuck is 6,500 crores. So
what is the total capital gone in to build?
No, I don't have. We can quickly check.
Actually, it's not a fair comparison, because if you look at post-COVID, the capital used. हाँ अब नहीं उनका capital पहले thick stack में गया होगा, but if I look at the post-COVID pivot, the thin stack businesses don't require that amount of capital because they're like software businesses beyond. While your net dollar retention on your clients, as your clients grow, your billings grow, you don't need, I mean, of course, you'll get more new clients, but as long as you have a good low churn rate and you have clients paying you on time, paying you, not reducing your fee as they grow, broadly, it's a much more capital efficient business per se.
But numbers are 3,000 crores for Blackbuck and roughly 8,000 crores for delivery in terms of capital infused.
Yeah, correct.
In that ballpark.
But I also have a view that a thin stack business should be built where the TAM is, because thin stack business will be the 1-3% kind of businesses, right? Basically. So you have to think through, if 54,000 crore toll payment is the TAM today, let's say for the core business of Blackbuck, then probably if we make assumption that they'll make 1% of that, that's like a 540 crore of revenue pool that's available today, basically, right? So I feel like we'll have to figure out layering more products and increase the revenue pool out of that, basically.
But वो होगा ही ना, like Chirag said, if they
कर रहे हैं ना अभी fuel card कर रहे हैं, insurance services, all of that will start to happen through that.
Yeah.
I actually think we've underestimated the take rates in India on some of these thing stack businesses. I remember when Chirag was raising his first round, nobody could believe that his business could go to a high take rate. But I think as you are going back to the payment flow, as long as you're in the payment flow, your ability to do value-added services for your customers and for your merchants.
Yeah.
So in this case, truck drivers के लिए अगर यार भूल गया हूँ मैं top up करना, तो मेरे को डबल टोल नहीं लगेगा is a great value add, right?
Yeah. Yeah.
Or tomorrow, selling insurance to the truck owners, or making
Yeah.
sure that life insurance for truck drivers at a low cost. There are so many different
Yeah, बहुत सारे
monetizations
हैं.
that you can.
Makes
Fuel
sense.
pilferage is a big issue.
Huge, yeah.
They can track all of that with a fuel card. So there are many such small use cases which come up. And what I've interestingly realized is that when we go to a restaurant, we judge the restaurant by the price of the famous dish. Nobody asks for कि पानी की bottle कितने की है. So value added services में सबसे ज़्यादा margin है. Main में कोई नहीं बना.
No, I really like. I really think like some of these business models which involve very sticky customer service, a part of the payment flow. But figure out business model. Like for me, I think MyGate is just a beautiful. We should cover that at some point in the asymmetric series. I think I use that app to be like 4 times a day now, right? On something.
Yeah, but Shantanu, क्या हो रहा है ना? I think we are interestingly, the reason one of the reasons we are covering more and more public companies is because the data is available. It's very unfair for us to look at anecdotal data and then maybe give some guidance on what we think, because we don't know whether A, the data is correct or not, B, maybe it's too small a sample set. So, but I agree with you, Ravindra.
मैं तो बोल रहा हूँ, as a consumer, it sounds like a place where I'll give MyGate money, a lot more money than I give them right now.
I actually have a reverse view. If I look at my society, there's too much complaint on यार इतना ads है, मतलब एक simple चीज करने के लिए उल्टा चल रहा है.
बस हो गया वो, अब convenience fee आने वाला है.
I'm pretty sure there's going to be a convenience fee soon, because the cost at which it's been sold to societies, in fact, a lot of times societies are getting paid to, because there's a duopoly there also, right? I think between no brokerhood and MyGate, or maybe there's a third.
Park Plus also in that same game or no?
No, they are in the fast-tag business for consumer vehicles.
Consumer vehicles, passenger vehicles.
बढ़िया.
Interesting, guys.
Any other top of mind? Revant, you're always a chess update from your side?
I'm just disappointed that it's still 4-all after 8 games, and
3.5 all, no?
today's game also was a draw.
Oh, today was. Oh, yeah. Today. Oh, yeah. Today the big was it right? No.
Yeah, and it was a drawish position from beginning. But yesterday's game 7, so I'm just. I mean, he was almost +5 at high depth computers, and I mean, most people were surprised that he couldn't convert a winning position. He was up on time as well. So I don't know. It's just been broadly a little disappointing World Championship. People are now clamoring back for Magnus to come back and play, because, they're just like, World Championship of Chefs cannot be like at the highest level. You can't have average play, which is what is happening on both sides. There are too many mistakes. Maybe it's nerves, maybe it's lack of preparedness, we don't know. But though GoKwik still seems to be keen to go in for the kill, he seems to be playing a little bit more aggressively than he usually is, but uncannily he's also making a few mistakes. So let's see. I mean, I'm really hopeful that 6 more games he come, because it's going to be hard for him in the rapid, and if it goes to tie breaks, which is the faster time formats, he's actually historically he's never played the rapid time formats well. So classical is what suits him more. He has to try and wrap this up in the classical format only.
I'm looking forward to Man U Arsenal tonight at 1:45. Weird time, but
Please don't stay awake till 1:45. फिर तेरे बाद भी Reddit या Quora पे आएगा कि टॉक्सिक एनवायरनमेंट है, 2 बजे तक सोता है, फिर अगले दिन सुबह 2 बजे ऑफिस आता है. I don't know whatever is going on. So somebody, some of my employees showed that to me. I'm like, boss, right now in this aggressive market share war, it's just become very hard to know what is real and what is PR.
Sorry?
We don't know if it's just negative PR, right? Just on you didn't see the Zepto story?
He cracked a cool joke about it also. Okay, I'm hoping
There is an employee rant on Reddit where somebody has.
Oh, no, I've not seen it. Oh, wow, really?
You haven't seen this? That's why he frustrated with it. No, I don't.
I did decide funny one day.
No, boss. There's a proper employee rant about Zepto work culture and stuff, and I think it's unclear. I would just say this, that I don't know whether it's real, whether it's just someone doing ungli ki yaar chalo jaake competition ka
See, it's a very sensitive issue. Like how much to work-life balance, very sensitive issue. Interesting. Especially after COVID now.
But I think ये 2-3 दिन चलेगा ही. And somehow, I don't know, have you guys realized this? Whether it's Swiggy, Zomato or Zepto, they figure a way to be in the news all the time. Even if it's negative PR, it's always PR. Like the amount of noise I'm seeing on LinkedIn, on X about this Zepto work-life balance suddenly. And people are cracking jokes. I mean, people are just having fun with it. But they are in the news. I'm pretty sure their orders have gone up today.
आप ये देखो ना asymmetry है देखो ना 4 episode में 3 of them we have covered these guys only, no?
Correct. You're right.
There are so many public companies, but we all do. So I think it's an exciting experience.
No, we covered Blackbuck today. ऐसा मन कहता है. It's a अच्छा thin stack, non exciting business बना रहे हैं जहाँ पे मार काट नहीं हो रही है, रोज कुछ न्यूज़ में नहीं आ रहा है. It's the boring business that idly, शांति से पैसा बना रहे हैं. अच्छा स्टॉक मार्केट बढ़िया चल रहा है. No, not a recommendation. Please don't flag us to SEBI. We are not Fed influencers. This podcast is not a recommendation for any public. It's just that we have to rely on publicly available data that we know is factually true.
Another big work-life balance critic, Elon Musk, lost a court case battle for his compensation to get $201 billion. I think it's beyond the point of zeros make no sense, but some Delaware...
Second, right?
He had like this, the shareholder had approved like $100 billion payout for him given the stock price. Like there was a clear formula. And a Delaware judge basically said, no, it's too much. Like the shareholders are too much in control of Elon.
No, it was not 100 billion. It was, I think, 6 or 7% of a grant, which was 55 billion then about 6 months back.
It's not.
Get the Delaware, because the share price has gone up. I thought there was a second shareholder resolution and they approved it again. Has it gone?
Again, it was cut out. And that judge apparently paid like the lawyers like a 340 million. The lawyers had asked for like a 10 billion in Tesla shares. I would love to like kind of go deep and understand that, but broadly CEO compensation in the US is a good topic to cover at a later date. But it's very interesting.
So it's a
who all the does.
Second time हुआ है ये.
Second time हुआ. And he has 30 days to
the shareholders voted for it. Then the judge blocked it. The shareholders again did a vote and said, we don't care. I mean, almost everyone, I think there was a majority that again voted for it. And again, the judges ruled that you are not entitled for it. I don't know what's the... and initially, the attorneys had asked for some 5-6 billion as fees.
Fees.
Which now has come down to 345 million.
345 million in fees to lawyer. Can you imagine? The US is a different animal.
But also a $1 trillion company. I think it's...
Why did the attorney ask for $5-6 billion to do what?
Billion.
So usually क्या होता है थोड़ा US में, I think if there is a, let's say the way the fee structure works is there is a fixed fee that happens, and if you win a certain amount, the attorneys get a percentage. It's like investment banking है. आपका 1 billion का IPO करा है तो 2% fees मेरे को मिलनी चाहिए type से, right?
So who will pay them?
They ordered Tesla to pay. But then obviously they didn't pay, and then they again did a shareholder meet, and it seems like the judges struck it down and has reduced the fees. But I don't know what's going to happen. This is crazy यार. छोड़ मतलब हम लोग गरीब देश में यार ये सब क्या बात कर रहे हैं. छोड़ना प्लीज.
अब जेप्टो का लेटेस्ट राउंड 350 मिलियन का है.
वहाँ पे लीगल फी दोपहर के आ ही जाते हैं जेप्टो स्विगी इंस्टॉल और इस ब्लिंकिट पे.
That's top of mind यार.
हाँ, of course.
मतलब मैं तो भूलने की कोशिश भी करता हूँ. आज आई मेट टू ऑफ वेरी न्यू सर्कल पीपल. वो भी जेप्टो में इन्वेस्टर हैं. तो मैंने बोला कुछ तो वर्ल्ड इज कंट्राइविंग अगेंस्ट मी. आई ओनली हियर अबाउट दिस देम.
इंडियंस थे वो.
नहीं छोड़ो अभी वो.
By the 3 people on my cap table have called and asked कि यार जेप्टो में इन्वेस्टमेंट करा दो. Is there an opportunity to invest?
आदित्य को तो फोन बोल दे, पैसे है मेरे पास.
आदित्य बोलेगा तो फुलफिलमेंट रेट ठीक कर ले पहले प्लीज.
Stop. You need to have Motilal Oswal account.
But yeah. Anything else top of mind, Darshit? City,
What's our match begins on Friday? Pink ball.
By the way, इतना gap.
Any predictions?
or second test में? Why was such a long gap? बहुत ही लंबा गैप हो गया.
Yeah, even I was surprised.
Couple of preparatory matches and all also they हो गया ना.
You paid fear मिला
This, no? Why would you do the test match and then do preparation for the race? समझ में नहीं आया.
Ping ball, red ball to ping ball transition का I think 1-2 preparatory matches खेला है वो.
नहीं कुछ नहीं. 2 दिन 3 दिन मैच के लिए 15 दिन का गैप क्या कर रहे थे? कुछ तो
घूमने
I don't know. Going to really on. No, it's uncanny. Usually we have a very tight schedule for tests because the money is an IPL and the audience is an IPL, right? Or whatever, T20s. So if you see the number of T20s to one days to test matches, the number of days of cricket played, it's all now indexed towards the shorter format. So I'm quite surprised that they are in Australia for 2 months just for 5 tests. But you know what's happening? पैसे वैसे आप actually one important thing should happen from this podcast. You should be able to get some fans to come over and say, Darshit, please take our money and invest in exciting startups that we would love to see go public.
Do you know, I was just checking out the Nvidia plus Apple market cap is $1.5 trillion more than the entire market cap of Indian public companies. So the fact that Nasdaq, like at that again, it's a baseline value, but it's quite interesting.
Why do you guys have to insist on making us feel गरीब every time you bring up ये सब? छोड़ दो ना यार. हम ठीक है. ये सब बड़े million trillion number मत बोलो तो. इंडिया में.
The good part is India's market cap is higher than India's GDP by almost like 15-20%. So that way, public exposure is good. So that way,
You can look at it two ways, right? Maybe it's overrated as a market. कि भाई GDP इतनी है औकात में रह करके.
also true. नहीं यार, बढ़िया है. This has been awesome. We planned for a sharper episode. I think we've gotten it. For me, this is a very educative experience in never listening to folks like you. Very happy to just sit in and listen.
No, great, yeah. I think hopefully our change of timing now, instead of releasing on Mondays, if we release on Fridays, all of you will get a lot more time to watch the episode over the weekend. Not the folks at Zepto because they continuously work 7 days. You know, all the other folks can watch us over the weekend and do let us know your feedback.
How about your employees, Revant?
Mat ja. Let's not go there. Thankfully, we are not large enough that we are talked about much.
नहीं बढ़िया. Thank you so much, and please keep giving in feedback on how we can do this better. I think the charts, I think on audio that become a little difficult to follow what we have to do on charts. We have to figure out how to do that. Even like some of these Excels are slightly heavy, and
We'll do links this time in this episode. We'll put out some links that we referred to so that you can tick those links and then at least refer to those charts as much as possible.
I should also upload the Excel on the YouTube description for a file of
We'll put it on the Google sheet and then upload that as well.
बढ़िया. Thank you, Darshit sir. Always a pleasure.
Thanks a lot, guys.
Thanks Darshit. It was quite, your if काफी sharp आपने बातें करी हैं आज.
Thank you.